Here now with more on the bank hearings is an official fresh off her own testimony before the House and the Senate in Washington. Adrienne Harris is here, Superintendent of the New York State Department of Financial Services. Good morning to you.
Good morning.
Do you think that there's a way to prevent these runs in the future? Is this about guaranteeing deposits or is it about something else?
I think it's about a lot of proposals that lawmakers are discussing along with regulators, whether it's modernizing deposit insurance, thinking about liquidity and capital requirements. So there's a lot of proposals on the table that regulators and policymakers are working on now.
So there's a lot of, but is there something you think that'll actually be effective? And the reason I say this is we all immediately go to deposit insurance. If everybody, if every deposit was insured, nobody would want or have a reason to ever leave the bank. But then you start to think to yourself, well, if you were CFO of a company or treasurer of a company and you started to see the stock of your bank tanking, even if you thought the deposit was insured explicitly, you might say to yourself, you know what, I'm going to move the money anyway. And then what do you do?
Right. Well, first, it's important to understand that the banking system is safe and sound and resilient. The government's taken great steps to make sure that's true. But I think the FDIC's put forward some important proposals around business accounts versus individual accounts, and it'll be incumbent upon federal regulators and lawmakers to make the proper changes.
Yeah, I would even say, the idea of insuring all deposits in some ways is a bad moral hazard kind of use, because you're basically telling the companies like Silicon Valley Bank that their executives did the right things, which they didn't. They were reckless and weren't watching what was happening, weren't paying attention.
Well, and I think that's part of the discussion, is really separating the accountability of executives and finding ways to continue to protect consumers, depositors, and the small businesses that we saw at some of these banks.
But let me ask you a different question. Is it possible that we could argue that the banking model is now fundamentally broken, that the digitization of finance has fundamentally changed the business? Because you have deposits which really can flee. I mean, there was a time where you'd have to go around and, wait on the street to get to see the teller or at least call somebody. And now you can have $42 billion leave a bank in the course of 4 hours. And if that's the case, and you'd either have to leave, there's no way to insure those deposits in any meaningful way. And the mismatch of having deposits that can leave on any given day and loans that are going to go out for 5, 10, 15 years and longer, that just doesn't actually work.
Well, I think that's why regulators are really revisiting the liquidity models, the assumptions that we all use to model that sort of liquidity, the type of runs that are now possible because of technology.
But then you have a separate order function, which is, if that's the case, the economic impact is huge. The idea that you would have to reduce the amount of credit look, in the world you're talking about, or the world I'm even mentioning, you're saying maybe just leave all the deposits in one place so that they're available at any given time. Well, if that's the case, that's actually terrible for the economy.
Yeah, well, we have to make sure that small businesses can continue to get loans, that marginalized populations can continue to get loans.
How do you do that and make sure the bank works at the same time?
Yeah, you have to preserve the diversity of banks that we have and make sure that the regulations are tailored appropriately
it's sacrilegious to say this idea that community banks, nobody wants to undo the community. But is there an argument to be made that having 6, 7, 8 banks in this country might actually be better than having several thousand banks? I ask, and then figuring out a way to incentivize those large banks to loan money and to participate in economies and communities that they might not otherwise participate in.
I think the diversity that we have across the banking system is really important. You have banks that understand their individual communities. They understand agriculture. They understand the types of businesses that they serve. And I think that diversity is important, and it's what contributes to making this the best banking system in the world.
But when you think about the reasons that people are sometimes banking at those institutions, it's because they're offering rates that the big banks won't.
Well, I think that's part of it, but it's also, you hear from small businesses, you hear from students who bank at their credit unions, that those institutions really understand them. They understand their needs. They understand their businesses. They understand the local markets.
Well, that's because
really
they're
important.
There right now.
Well, they're there and they're on the ground, and I think that's important.
And then the question, but I guess what I'm asking is, if you had 7 or 8 big banks, I'm not arguing for this. I'm just, but there is an argument to be made that this is a very fractured, completely inefficient market, and also a very difficult market, frankly, to regulate properly.
Well, I think that's part of the beauty, too, of the dual regulatory system, right? You've got federal regulators, you've got state regulators, we've got tailoring of regulations.
That has never covered themselves in glory. You disagree with that?
No, I think the system works very well, and we've seen how resilient it is in the face of this crisis. So I think it actually proves the model.